Want to know how the ultra-wealthy legally pay zero taxes? It's a strategy called buy, borrow, die. Let me show you how it works.
All right, today we're doing a deep dive into one of the most powerful and, let's be honest, most misunderstood wealth building strategies out there. It's called buy, borrow, die. And yeah, the name sounds a little intense, but the mechanism behind it is actually this elegant and completely legal feature of the US tax code. So let's pull back the curtain and see exactly how this whole thing works. Everything, and I mean everything, we're about to talk about comes down to this one simple idea. Borrowed money is not income. That's not some sneaky loophole, it's a fundamental rule of our tax system. Think about it. The IRS taxes income. A loan isn't income. Once you really truly grasp that, you've found the key that unlocks this entire strategy. And if you want to see this in action, just look at these numbers. It's staggering. A few years back, ProPublica got their hands on some real IRS data, and they found that between 2014 and 2018, the 25 richest Americans saw their wealth grow by an incredible $401 billion. So what was their tax bill on that gain? A tiny 3.4%. To put that into perspective, someone making an average salary pays maybe 15–20%. Warren Buffett's true tax rate on his wealth growth during that time was just 0.1%. So the big question is, how on earth is that possible? Well, to answer that, we've got a roadmap. We're going to start with the so-called billionaire tax secret. Then we'll break down the buy, borrow, die strategy itself, piece by piece. After that, we'll get into the legal magic that makes it all possible, something called stepped-up basis. And then, the fun part, how you might be able to use it. But crucially, we'll cover the rules for staying safe before we wrap up with a totally new way to think about the real cost of paying taxes. Okay, let's kick things off with Section 1, the billionaire tax secret. And trust me, it's probably not what you're imagining. So let's just get one thing straight right away. This is not about hiding money in the Cayman Islands. It's not about shady shell companies or fake charities. This is not illegal tax evasion. It is a method of tax avoidance that is perfectly legal, written directly into the tax code for over a century now. The IRS didn't miss this. They literally wrote the rules that allow it. And that brings us right to the strategy itself. I want you to think about it like an escalator to wealth, and it has 3 very clear steps. The process is deceptively simple. First, you buy assets that you expect to grow in value. Things like stocks, real estate, a business. Step 2, when you need cash to live on, you borrow against those assets instead of selling them. And third, you hold those assets until you die. And that final step, strange as it sounds, is what triggers this incredible tax advantage for your heirs. And this is where that escalator metaphor really clicks. Imagine your growing portfolio as an escalator, just steadily carrying you upwards over time. When you need cash, you have 2 choices. You can sell. That's like taking the emergency exit staircase. You step off the escalator, your wealth stops compounding, and you immediately write a huge check to the IRS for capital gains. Or you can borrow. This is like staying on the escalator. Your assets stay invested, continuing that upward ride. A bank gives you the cash you need, and because nothing was sold, there's no taxable event. The IRS sees nothing because there's nothing for them to see. You're still on the ride. Now, so far, everything we've talked about is just tax deferral, pushing the tax bill off into the future. But this next part, this is where the strategy goes from smart to, frankly, unbelievable. This is how that deferral turns into a permanent, legal elimination of the tax. So let's make this super concrete with a real-world example. Imagine years ago, you put $100,000 into a simple S&P 500 index fund. It did its thing, and today it's worth $450,000. That means you're sitting on $350,000 of pure, unrealized profit. Now, let's say you need $250,000 in cash for a big life event. You've got 2 choices. Okay, option 1, you sell. Well, you have to pay taxes on your profit. So if we assume a top federal capital gains rate, that triggers an immediate tax bill of almost $50,000. Poof. Gone. And that's just federal, not even counting state taxes. Your assets are gone, and the compounding on that chunk of your wealth has stopped. Forever. Now let's look at the other path. What if you borrow instead? You go to a bank, you take out a loan for that $250,000 using your portfolio as collateral. Now at a pretty typical interest rate, that might cost you, say, $17,500 a year in interest. But here's the kicker. Your entire $450,000 portfolio is still in the market, still working for you. If it just grows by its historical average, it could make over $30,000 in a year, more than enough to cover the interest. You get your cash, your portfolio keeps growing, and your tax bill is zero. So what happens to that loan? And what about all those deferred taxes? Well, this is the grand finale. It's a part of the tax code called Section 1014, the stepped-up basis. It's simple. When you pass away, the original cost of your assets, your basis, is legally reset or stepped up to whatever its market value is on the day you die. All those decades of capital gains you built up, from a tax perspective, they are legally and permanently erased. And this table just lays it all out, black and white. Look at this. Let's say you built a $2 million portfolio from an original investment of just $200,000. You've got $1.8 million in gains. If you sell that during your life, you're looking at a federal tax bill of over $400,000. But if you hold it until death, your heirs inherit that portfolio with a new cost basis of $2 million. They can sell it the very next day for $2 million, and guess what? Because the gain is mathematically zero, the tax owed is zero. They can sell a small slice to pay back any loans tax-free and keep the rest. That one rule just saved your family almost $500,000. Now, I know what you're thinking. This sounds way too good to be true. Surely politicians have tried to close this. And you're right, they have. The fight to repeal this goes all the way back to the 70s. Most recently, the Biden administration tried to get rid of it in 2021, but every single attempt has failed. Why? Because a really powerful and broad coalition, from billionaires all the way to family farmers who just want to pass down their land without a crippling tax bill, has fought to protect it. So here's the key. While we keep hearing this called a billionaire strategy, the actual mechanics are accessible to way more people than you'd think. So let's talk about how you could actually use this. There are basically 3 tiers of access here. The first is a simple margin loan, which you can get at pretty much any brokerage. It's the easiest to get, but it's also the riskiest because a sharp market drop can trigger a margin call, forcing you to sell at the worst possible time. The second tier, and this is what the pros use, is a pledged asset line, or a PAL. This usually requires a bigger portfolio, but the terms are much, much more forgiving. And the third tier is one you might already be familiar with, a home equity line of credit, or a HELOC. It's the exact same principle, borrowing against an appreciating asset, your house, which, by the way, also benefits from a stepped-up basis. Okay, stop. This is, without a doubt, the most important section of this entire explainer, because using leverage, which is just a fancy word for debt, is a double-edged sword. It can be an amazing tool, but if you're not disciplined, it can be absolutely catastrophic. If you want a real-world horror story, look no further than the collapse of Archaeos Capital back in 2021. The head of that firm, Bill Huang, was using the same basic mechanic, borrowing against assets, but he took it to a completely insane extreme. He was massively over-leveraged in just a handful of stocks, so when those stocks dipped just a little bit, that extreme leverage created a death spiral. We were talking about $20 billion, with a B, dollars in value that just vaporized in 2 days. It's the ultimate cautionary tale. So how do you avoid that? How do you use the power without getting burned? You follow 3 simple, non-negotiable rules. Rule 1, diversify. Never, ever borrow against a single stock. Always use a broad, diversified portfolio. Rule 2, keep your loan to value, your LTV, low. A good rule of thumb is to never borrow more than 30% of your portfolio's value. At that level, the market would have to crash by more than half before you'd even be in danger of a margin call. And Rule 3, cover the interest payments with outside income, like your salary. You never want to be in a position where you're forced to sell assets in a down market just to pay the bank. Okay, so as we wrap up, let's zoom out a little bit, because using this strategy correctly isn't just about the math. It requires a huge shift in your financial mindset, especially about taxes and debt. See, we're all taught to think of taxes as a one-time cost. You sell a stock, you pay the tax, you move on. But that's not the right way to see it. The real cost of that tax payment is the ghost of the future wealth it could have created. Every single dollar you send to the IRS is a dollar that has been permanently pulled off that escalator of compounding. The tax isn't just what you pay today. The real tax is what stops growing forever. So let's leave you with 3 actionable things you can do right now. First, make it a personal rule. Before you ever again sell an asset from a taxable account, always get a quote for a loan first. Just run the numbers. Second, do the math today. Figure out what 30% of your current taxable portfolio's value is. Just knowing that number, your safe borrowing capacity, gives you so many more options. And third, really internalize this core idea. Every year you hold on to an appreciated asset, you are moving a tax problem from your lifetime, where it's a very real cost, to your state, where, thanks to the tax code, it can literally vanish. And that really leaves us with one final big question to think about. We're all taught that debt is bad, that it's a liability we have to get rid of. But what if that's only half the story? What if when it's used strategically, with discipline, debt isn't a chain at all? What if it's actually the single most powerful tool you have for building and preserving wealth for generations to come?